In Chapter 5, we talk about inventory costing. So we're going to do an example with all four inventory costing methods: specific identification, FIFO, LIFO, and weighted average. So you can see the comparison between the four different methods. We start with specific identification, which is used by businesses with very unique products, where they can tell exactly which ones are being sold and purchased because of their unique identities. So when we start looking at this example, we begin March 1st with 100 units in our beginning inventory. Then we purchase an additional 400 units. That means we have 500 units in our inventory. We have 100 that were $50 and 400 that we just purchased at a cost of $55 each. This gives us a total inventory of 100 times 50 plus 400 times 55, or $27,000. We then sell 420 units at $85 per unit. It tells us in our instructions that the March 9th sale consists of 80 units from beginning inventory and 340 units from the March 5th purchase. So this total is 80 at $50 and 340 at $55. So our cost of goods sold on this sale is 80 times 50 plus 340 times 55, or a total of $22,700. We now have in our ending inventory 20 units left of the $50 cost units and 60 units left of the $55 cost, for ending inventory of 20 times 50 plus 60 times 55, $4,300. We then purchase 120 units at $60 per unit. Now we have three levels of inventory cost. We have 20 at $50 from our beginning inventory, 60 at $55, and we've just purchased an additional 120 that were $60. Now our ending inventory is 20 times 50 plus 60 times 55 plus 120 times 60. We then make a purchase of 200 additional units at $62 per unit. So we have the same 20 at 50, 60 at 55, and 120 at $60. Now we have another 200 at a $62 cost. So we need to add those 200 to our previous calculation, 200 times 62. Now we have inventory of $23,900. On March 29th, we sell 160 units. It tells us that that sale consists of 40 units of the $60 per unit and 120 units from the March 25th. So this is 40 at $60 and 120 at $62 each. So our cost of goods sold for this sale is 40 times 60 plus 120 times 62, or a total of $9,840. Now in our ending inventory, we still have those 20 from beginning inventory at $50, 60 at $55. We have 80 left of the $60, and we have 80 left of the $62. So our ending inventory is 20 times 50 plus 60 times 55 plus 80 times 60 plus 80 times 62. So with specific identification, in the month of March, we have total cost of goods sold of $32,540 and total ending inventory of $14,060. Now we're going to look at FIFO, which stands for first in, first out. So our first costs are our first ones that get sold. So this first purchase or addition to beginning inventory is the same as it was with the specific identification. So we have after our first purchase, we have the 100 times 50 plus 400 times 55, or 27,000. Now, when we make this sale on March 9th of 420 units, we sell all of our beginning inventory costs first. So 100 of them are our beginning inventory at $50. The next 320 come from the $55 purchase for a total of 420. This gives us a cost of goods sold of 100 times 50 plus 320 times 55, $22,600. Our ending unit inventory now is 80 units at $55. On March 18th, we purchased 120 units at $60 per unit. Now we have 80 units at $55 per unit and 120 at $60 per unit for total inventory of 80 times 55 plus 120 times 60. We then purchased another 200 units at $62 per unit. So now we have 80 at 55, 120 at $60, and 200 at $62. So our inventory is this 11,600 plus 200 times 62, the ones we just purchased. We then sell 160 units. So we need to get rid of these 80 units at 55 first because we're using FIFO. So 80 at 55, and then the other 80 are from the $60 cost pool. So our cost of goods sold is 80 times 55 plus 80 times 60, or $9,200. And our ending inventory now, we have 40 left of these $60 ones and 200 of $62. So our ending inventory is 40 times 60 plus 200 times 62. $14,800 versus a cost of goods sold of $31,800. 500. We're now going to go through the LIFO. LIFO is the exact opposite of FIFO. So we have last in, first out for costs with LIFO. Remember that inventory costing does not need to follow inventory actual flow. So we would have first in, first out in our physical flow, but we would use last in, first out for our costs. So that purchase is the same as it was under specific identification and FIFO. We've added 400 units at $55, so we have 100 times 50 plus 400 times 55, 27,000. Now, when we sell these 400 units, 420, 400 of them are at the $55 cost, the most recent cost we just added, because we're using LIFO. So last costs are the first out. And the additional 20 come from our beginning inventory of $50 per unit. So our cost of goods sold under LIFO is 400 times 55 plus 20 times 50. And our ending inventory is 80 at $50. We then purchase 120 units at $60 per unit. Now we have 80 units at $50 and 120 units at $60. So our inventory is 80 times 50 plus 120 times 60. We make an additional purchase of 200 units. Now we have 80 units at $50, 120 units at $60, and 200 units at $62. Total inventory, 11,200 plus 200 times 62. We now sell 160 units. Because these are last in, first out, all 160 units come from this $200 pool, or 200 at $62. So our cost of goods sold equals 160 times 62. And our ending inventory is 80 units at $50, 120 units at $60, and 40 units at $62. 80 times 50 plus 120 times 60 plus 40 times 62. And our last inventory costing is weighted average costing. So under weighted average, every time we make a purchase, we come up with a new average cost for our inventory. So when we purchase 400 units at $55 per unit, we now have 500 units. So we need to calculate a new per unit cost. So we would take our 100 units times $50, parentheses, plus the 400 at $55, and we get a total of $27,000. We want to take that total and divide by our total 500 units to come up with a new average cost. So now we have 500 units at an average cost of $54 per unit. When we sell 420 units, then our cost of goods sold is 420 times 54. And our ending inventory is 80 units at $54 per unit. 80 times 54. Then we buy another 120 units at $60 per unit. So we need to calculate a new average cost. So we take our 80 times 54 plus 120 times 60 gives us $11,520. We take that and divide it by 200. 80 plus 120 is 200. We now have an average cost of $57.60 per unit. Now we have 200 units at an average cost of $57.60 per unit. Then we buy another 200 units. So we need to come up with a new average cost. So we take our $11,520 and add 200 times $62 for a total of $23,920. We're going to divide that by our now 400 units. We now have a weighted average unit cost of $59.80. Now we have 400 units at $59.80. Then when we sell 160 units, our cost of goods sold is 160 times $59.80. And our remaining inventory is 240 units at our average cost of $59.80. Weighted average is becoming more popular, but it still isn't as popular as LIFO or FIFO. And part of the reason for that is because of the complication of having to come up with a new average cost every time you purchase inventory. What we've been looking at is an inventory record for one piece of inventory. If we were a business that sold 100 different items or more, we would have to keep an inventory record for every individual item. With computer inventory records, this becomes easier because every time we scan a barcode, our computer inventory is going to update itself. When we look at this comparison then, these are our four methods and our four costs. LIFO has the greatest cost of goods sold, which gives us the smallest gross profit. Many businesses that use LIFO do so for the tax advantages of it, so that they have a higher cost of goods sold and a smaller tax burden. Our last example for Chapter 5 is a lower of cost or market. When a business has inventory whose market value has moved below its original cost, which means that they would no longer be able to sell it at a profit, but they would take a loss on it, they are able to write down their inventory to the lower of their cost or market price. So we have a business here that has done the analysis of their market cost versus their per unit cost. And what we want to do is we want to figure what's the lowest, the cost or the market value. So you would take the total units times the unit cost. If we select corner, we can carry that formula down, and then we can sum this entire column, and that is the current carrying cost of all of our inventory. Then we're going to look at the total market cost. So we have the per unit market cost. This is not the price that they would sell it for. This is the market value to replace their current inventory. So this is what it would cost them to buy new inventory. We take the number of units times the market cost. And again, we can carry that formula down. And we can sum and see the difference between our cost and market. In this last column, we want to determine what is the lower of cost or market. So we look at each item individually. For our speakers, it is the cost that is lower. For stereos, it's market cost. For amplifiers, it's our historic cost. For subwoofers, market cost. For alarms, market cost. Locks, market cost. Cameras, total cost. And tripods and stabilizers, it is our historic cost. We sum up that column, and that gives us what our current lower of cost or market is for our items. So now we want to rewrite our inventory. So this is our inventory carrying amount right here, this $292,517. We can write it down to $2,073.54 using the lower of cost or market rule. So we want to know what that minus our new valuation is, $19,463. So we would then have a journal entry where we would debit cost of goods sold for $19,463 and credit merchandise inventory for $19,463.